Hello everyone, welcome back for our panel on investment trusts. The first investment trust was launched 154 years ago, and it still exists today as F&C investment trusts. For over a century and a half, investment trusts have provided a way for private investors to gain access to certain investments they might not be able to otherwise. The first investment trusts were entrepreneurial schemes funding projects such as railroads, early techs and oil fields and rubber plantations. Today, they are funding a new wave of innovation, from renewable energy to infrastructure and even space technology. Call these megatrends. To explore the opportunities and challenges, I'm joined by a panel of investment trust experts. First up, we have James Carthew, co-founder and head of investment company research at Quoted Data. James started his career at M&G in 1984, where he came to manage a number of UK equity funds, as well as M&G's fund of investment trusts. From 2001 to 2010, he managed Advanced UK Trust, a global fund of funds. We're also joined by Emma Bird, research analyst at Winterflood Securities and CFA charter holder. Emma has been a member of Winterflood's investment trust research team since 2015, having previously worked with the Wealth Management Association. And last but not least, we have Richard Stone, Chief Executive of the Association of Investment Companies, the trade body that covers investment trusts. He's been in the position since September 2021, and before that, he was Chief Executive of Share PLC, which owns Share Centre, the retail investment trust platform. Thank you to Quoted Data for sponsoring this panel discussion. I recommend all of you have a look at their website. They have excellent investment trust research that's freely available. And a bit of housekeeping, please be sure to ask any questions on the right-hand side of your screen throughout. And please note that the session will be available on demand for 30 days, a few hours after this has ended. Right, let's get going. Richard, we'll start with you. Can you just start by briefly telling us what an investment trust is and how it compares with a unit trust or an ETF?
Hi, Mary. Yes, thank you. Of course, an investment trust or investment company is effectively a pooled, closed pool of capital. It is a company. It's listed on a stock market. Its shares are traded as for other companies. But the purpose of the company is to take that pool of capital and then invest it on behalf of its shareholders to earn a return. As I said, it's listed on a stock market and its shares are traded, and therefore you, when you invest, buy shares in an investment company, you're buying them at that market price, and we'll perhaps touch on that a little bit later. Relative to a unit trust or an ETF, a unit trust or an ETF is an open-ended structure. They typically, when you invest, you would be investing at the net asset value of the underlying investments. They would have redemptions and creations, and an investment company doesn't have to deal with that. An investment company has a couple of other structural benefits. It can borrow money, so it can gear itself, which, if done properly, can help improve returns for investors, and it can also retain a portion of its income. It doesn't have to pay all of its income out as dividends, which enables it to smooth its income over time, holding some back in the good times to help in the perhaps slightly more barren times. So some of our members have increased their dividends continuously for over 50 years, for example. So there's a couple of sort of structural differences there as well. And because of the closed nature of that pool of capital, I think, picking up the title of this session, investment companies are particularly good at investing in assets which are less liquid, are sort of cutting edge, and as you said, the investment company structure goes back 150 years, and I think it's fair to say they've always been investing in and giving investors access to sort of frontier companies, frontier markets and technologies through that period of time. So they very much stood the test of time and delivered for investors along the way.
Thank you, Richard. Yes, they had a record year for fundraising last year, and that was largely in the unlisted asset space, as you said. Emma, perhaps you could give a bit more detail on this. What options are there for investors among illiquid assets?
Yeah, so as Richard touched on, investment trusts offer exposure to a wide range of asset classes, including listed equities and bonds, but also they're ideally suited to more illiquid assets, from infrastructure and property to private companies. And as you said, a key area of growth in the investment trust sector in recent years has been infrastructure. And within that offers exposure to the megatrends like renewable energy or digital infrastructure. So at the moment, there's 22 trusts with total assets of over £20 billion that provide exposure to renewable energy related infrastructure. So from wind farms and solar farms to battery storage assets, for example. And then more recent fund launches have also can also provide exposure to the megatrend of digital infrastructure, with 2 dedicated investment trusts launched in the last 18 months. And also a number of investment trusts that offer exposure to secular growth themes such as space technology or biotechnology, with the underlying investments there being both listed and unlisted companies. I'd say another important megatrend at the moment is ESG or sustainable investing. Pretty much all investment trusts have an ESG strategy included within their investment policy. And as well as that, there are also some that are specifically focused on providing environmental or social benefits as part of their investment. For example, those that invest in environmentally friendly businesses or social housing, for example.
Thank you. Yes, it does. In terms of megatrends, it does feel like renewable energy is really the big one. And it's certainly an area where investment trusts have a lot of investment options. Before we bring James in, another question for you, Richard. Could you just briefly explain how these renewable energy trusts work and what type of returns investors might hope to achieve?
Well, I mean, they work as with any other investment company, but they are specifically investing in technologies and in companies which are operating in that renewable energy infrastructure space, and they would generate their returns from their underlying investments. So if they're in green energy generation, for example, then the underlying companies they're invested in will make a return, and the fund benefits from that and can then return that onto their shareholders, either in terms of capital growth or in terms of income, or both. That's effectively how that flows through to the end investor. I think what is worth saying is that an investment company, by investing in an investment company, you are investing in a fund. So the investment company provides a degree of diversification, either across assets in different asset classes or within an asset class by investing in multiple assets in that investment in that asset class. So as an investor using an investment company, you're both diversifying your portfolio at a higher level, but you're also within the investment company itself gaining a degree of diversification in your portfolio.
Thanks. And James, do you have any guidance on how investors can do due diligence on these trusts? Because the returns look good, the inflation linkage is attractive, but the way the NAVs are calculated is quite complicated. So what do you view as the risks, and how can investors do due diligence?
They are a bit like swans swimming along the water. That there's look beautiful on the surface, but there's an awful lot going on underneath. So there's lots of component parts to what drives the NAVs and the returns of these things. But if you're talking about renewable energy generation, then obviously a key component of that is the power generated and what they sell that for. So some firms will sell that power in the spot market, which is the sort of live market that varies according to supply and demand. So that can be quite volatile. But as we know, power prices have been going through the roof recently, so that's been very profitable for many renewable energy companies. Some of them try to lock in those power prices for longer with what they call power purchase agreements. So they might be sold over a couple of years, maybe. And that means they have a bit more certainty of what their revenues are going to be. But for some of them, it's meant that they missed out on the highest of these prices. And then a big component has been the subsidies that the governments have been put in place to try and encourage the development of these things in the first place. So those are great for investors because they're inflation linked in the UK. And that's meant that as inflation's been rising and it's obviously been hurting consumers' pockets, but actually for these funds it means they're earning more income. So that's been good. There are also other wrinkles as well, but those are the two main things. So it's worth looking at how much of your fund is actually inflation linked income. When I know all of these funds disclose that, and then what sort of strategy have they taken in terms of selling the power? And again, they'll be disclosing that. And then it comes down to where those assets are. So they're not all in the UK. So most of them are, but some of them have ventured further afield. They've been going to Europe, Australia even. And those regimes are very slightly different. But the best place, maybe you come and look at some of our notes that we write. We do try and explain exactly how these things work.
Thank you. And Emma, there are also ones that focus specifically on battery storage rather than on the energy generation as the ones we've discussed. There are three in particular. How do these trusts work? And do you think they are attractive investment options?
Yeah, so battery storage has an important role to play in the transition to renewable energy. So battery storage assets can provide electricity power when the sun isn't shining or the wind isn't blowing by storing energy at times of peak generation and then discharging it at periods of low generation. So revenue can be generated by providing the grid with balancing services, which helps to match power demand and supply, and also through trading power at various times of the day or year. So buying when there's an oversupply of power in the grid and therefore energy is cheap, and selling it when there's high demand and low supply. And we think that returns in the battery storage space remain attractive, with the incumbent investment trusts offering returns about 10% per annum. And then there's potential for even higher returns for funds that could invest in construction or development stage assets as well.
Yeah, that's some very attractive returns. Also offering attractive returns in the infrastructure megatrend theme are the digital infrastructure trusts, two launched last year and have raised a lot of money. They have long contracts, they're in growth areas, which makes them look very attractive, but they're very few assets. So I think there might be some concentration risk. James, what are your thoughts on these trusts and if they have enough of a track record for investors to feel comfortable with them?
I think this is a fairly new asset class for the sector, and I think one of the strengths of the sector is that we do see these things come along from time to time, sort of brand new asset classes, and we haven't got to get our heads around. They're looking at things like data centers, mobile phone towers, subsea cables, the internet sort of fiber that's running down our streets. All these things they can sell access to on fairly long-term contracts, and that makes their revenue relatively predictable. But it does mean that there is a kind of variation there that you don't get with normal infrastructure funds. So normal infrastructure funds have very long-term contracts, mostly with governments. These are selling services often to companies, and there you've got a bit more credit risk, perhaps. So these are slightly different assets, they're slightly different animals to the renewable energy generation ones or to the infrastructure funds. And I think the jury's still out a bit, but so they're offering slightly higher returns. I think that's maybe the attraction. Because you're taking a little bit more risk of the unknown, that you're getting a slightly higher return. So I would watch these with interest. Definitely look more closely to them if they move towards discounts, but they're trading at reasonable premiums at the moment. They do have fairly concentrated portfolios, but as they raise more money, those portfolios are becoming more diversified. So it is interesting. It's fascinating to watch the development of them and the sort of things they're buying. I mean, for example, one of them the other day bought data centers in Iceland, which are powered by geothermal energy. So it's all sort of renewable and green and lovely. But we'll wait and see how the revenue for that pans out over the next decade.
Yeah. So, Richard, as James and Emma have both said, these trusts offer really quite attractive returns in a landscape where returns are quite hard to come by. But as James said, they also, maybe that comes at excess risk in a slightly unknown area. Do you have any guidance on how much of a private investor's portfolio these trusts capturing megatrends should take, or how much you would feel comfortable with someone putting of their own money in? So I know there are lots of factors, but any ballpark guidance would be great.
I think it's very difficult to give a particular figure because, as you say, it varies from investor to investor. I think the overriding point I would make is that as a private investor, you want to have a diversified portfolio, and investment trusts can play a significant part in giving you that diversification and access to asset classes which you can't get through other listed company investments or through other open-ended sort of fund structures, unit trusts or ETFs. So, they're giving you access to some of those frontier technologies. We've already talked about renewable infrastructure. We've talked about digital infrastructure. I'd argue if you wanted to access property as an asset class, etc., then using investment companies as a way of doing that is a really good way of diversifying your portfolio. So I don't think it's necessarily a question of how much of your assets you should put in investment trusts, so much as how can you use them to give you that diversification and diversified approach, so that you're not you've not got an overly concentrated portfolio.
Thank you. And James, one trust that launched to great fanfare recently was the Seraphim Space Trust, and it shot to a huge premium when it launched. It's now at a 29% discount, I think. Do you think this is a good long-term investment option?
It's a fascinating company, definitely. They had a capital markets day the other day that I went along to, where they actually brought along some of the companies that they're investing in, and they explained what they're trying to achieve. So it is a whole new area for investors to get their heads around. So the sorts of things we're talking about are companies putting satellites into space, companies that are helping get satellites into position more effectively, more efficiently, companies looking at how we clear up the debris in space, so we don't get the sort of gravity, it's gravity, isn't it, where the debris comes along and smashes the space station up. We don't want that happening. And there's so much going on, so much stuff being launched, and you can see that there are going to be sizable amounts of money to be made of this in the future. The trouble is that it's in exactly the sort of part of the market, this sort of high growth revenue in the future, not so much profit up front now, that investors are a bit wary of at the moment. Because interest rates are going up, they're demanding a bit more certainty, a bit more cash in my hand now, which is why people are favouring yield funds rather than growth funds. And Seraphim Space has been caught in the backlash against that. I would have thought on a 29 discount, it might be looking interesting, but it's very hard to get a handle on what that true NAV is. So it's not something to bet the farm on, but it's maybe something to tuck away for the very long term.
Yeah, thank you. And developing that point, Emma, what do you think about the net asset values in the growth capital private equity trusts generally? Because they can be quite concentrated, but the NAV calculation is likely to lag the market, and it's quite difficult to do. And it might take a while for them to catch up if they don't drop enough in time, is my understanding of how they work. What's your outlook for these trusts and how they might fare in an inflationary and possibly recessionary environment? Sorry, there's two parts there: the NAV calculation and how they would fare in the recessionary environment.
Yeah, no problem. So yes, as James mentioned, a lot of the kind of growth capital funds have seen significant share price falls recently, with the market rotation from growth into value against inflationary and rising interest rate backdrop. And yeah, as you touched on, the NAVs of these private companies are only to the valuations of the private companies, and therefore the NAVs of the funds are only calculated every few months or so. So some of the NAVs at present will be out of date, and in general they are expected to decline at the next valuation point, primarily because the listed companies with which they're compared will have seen share price falls in the intervening period. However, I'd say that these kind of companies are ideally suited to the investment trust structure, because the lack of inflows and outflows means that the fund managers can invest in them on a truly long-term view. And on the how they fare in an inflationary and possibly in recessionary environment, they will likely still face headwinds, as the market will generally continue to favour value over growth. But I'd note that a lot of the underlying companies will be disruptors or market leaders in their niche, so they could also actually do relatively well in an inflationary environment if they're able to successfully pass on the price increases to their customers and maintain profit margins. And finally, I guess I just say that we would view these trusts as long-term vehicles that are suited to investors with a longer-term time horizon that can overlook these short-term share price and NAV volatility.
Yeah, that's true. Thank you. And I guess if the NAV's lagging, the share price typically isn't. Richard, another question for you. We talked about the infrastructure trusts earlier, and a lot of them trade at quite high premiums to their net assets still, as yields hard to come by elsewhere. How comfortable are you with the premiums generally, and how do you think investors can take a view on whether the premium's likely to stay where it is and not impact their total returns in the longer term?
I mean, ultimately, as I said at the start, an investment company is a share. So you're trading shares on the stock market, and the price is determined by supply and demand. So if the investment company is trading at a premium to its NAV, it's because of demand for that sector and demand for what that trust is offering. And clearly, to justify that premium, the trust has got to deliver the returns then that see that NAV expand and grow into that. It's difficult to say what premium is too much or where that becomes too high. What you would expect to see is trusts where they are trading at a significant premium, potentially looking to come to the market to issue more equity and to grow their mandate and then take advantage of other investment opportunities. And you can see that in terms of some of the activity that's going on and some of the fundraising. Quite a lot of the fundraising that's been going on in the sector is follow-on funding, so sort of secondary funding into those existing trusts that are trading at a premium, using the fact they're trading at a premium to issue more equity and grow the size of that fund for investors, opening up other investment opportunities for the fund manager and things. So, I think that trading at a premium isn't necessarily a bad thing. Trading at a discount isn't necessarily a good thing, or vice versa. You've got to take your view on the long-term future of the fund. And I would just note that the point of caution that was raised in the previous comments around the lag that exists, particularly in alternative assets. It may be that actually it looks like it's trading at a premium, but actually the NAV is going to adjust upwards because those assets are delivering particularly high returns with strong energy prices, etc. And actually they may be valued upwards as a consequence of some of those factors. So you get the lag in both directions.
Yeah, that's a really good point. Thank you. I'm afraid we've only got time for one more question, which I'm going to ask James. There's plenty of megatrends that we haven't really covered yet. I think notable ones to me would be developed markets. There are 3 investment trusts that focus on Vietnam, which are very interesting and hard for investors to access otherwise. There's also biotech specific trusts, which have had a big sell-off, but are very interesting. There's Latin America funds. So of all the other thematic trusts, James, what do you think might be the most interesting, and can you explain their investment case?
The most interesting, actually I'm quite excited about Vietnam at the moment. It's one of these places where they're shifting manufacturing out of China and into Vietnam. That's really helping its economy. It's helping its currency. The whole thing is actually looking quite attractive at the moment. And there's also a chance that it's going to get upgraded from frontier market status, where it is now, to emerging market status. And that will mean that it means there's a lot more money going into that country, and the stocks will be re-rated upwards. So I think that might be quite an exciting area.
Great, thank you. Well, I'm afraid that's all we've got time for. Thank you, James, Emma and Richard, for joining us for this session. And thank you to our sponsor, Quoted Data. Remember to have a look at their website if you want to find out more about investment trusts. Please also complete the feedback form after the event, which you'll be emailed, and stay tuned for more Investors Chronicle events on our website. A panel hosted by my colleague Dave Baxter on evaluating ETFs, the affordable way to high returns, ? So please do stay tuned. That will start after the break. Thank you and goodbye.